Hi everyone, I'm Donna the Accounting Lady, and today we're going to talk a bit about balance sheets. Now, before I get going too fast, and I'm going to kind of slow down my speaking. I've noticed on a lot of YouTube videos, it sounds like the speaker is not stopping to take a breath, and it's a little bit frustrating for me because I was raised by Southern parents and they speak rather slowly. So I guess you can always speed up the video if you think that's necessary. So today I want to talk a little bit about the balance sheet. Oh, before I forget, because I will, if you enjoy these videos, please like, share, subscribe, comment below, let me know what other topics you would like me to cover, and that helps me a ton as I'm trying to develop this. So also there will be a link below telling you how to reach out to someone to find out, to get some really amazing bookkeeping. So comment below. So we're going to start off with the balance sheet. The balance sheet is one of the 3 foundational reports that I want my clients to understand, because when you look at a dashboard, and I know a lot of companies are going to this, that gives you an idea of what's going on in your business, but the financials are where you really get to the meat of the matter. This is where you really see what's going on in your business. The dashboards are fantastic, but I also think you should understand what you're looking at in a financial statement. This is something, the financial statements are drilled into us all the way through business school, so it's kind of important. So with that, we are going to kind of move over and take a look at a balance sheet. Now this one is, again, from the QuickBooks Sample Company. And we're going to start off by looking up here at assets. Some people's balance sheets are going to be much shorter than this. Again, this is a sample company. So under assets, we have our cash assets. Checking, this is petty cash, this is your savings account. And so this is what they have in cash that they can get to right this minute. Most people understand this, so I'm not going to spend much time on it. The next one is accounts receivable. Now this is money that is owed to the business. This is the money that they've invoiced for, they've done the work, now they're waiting to get paid. And it does show as an asset because the money will be coming in, and for the accrual method of bookkeeping, which is the most accurate method, the money that you earn is accounted for in accounts receivable at the time the service is rendered, or at the time you invoice for it. Next we have prepaid insurance. By way of explanation, prepaid insurance, we usually pay insurance in 6-month policies, right? So if it's a 6-month policy at $100 a month, they've used up 1 month of it, and there's still a balance here. So that does show as an asset. That's something you've paid for but you haven't used yet. Same thing with inventory, and there's several different ways to value inventory, which you should talk about with your bookkeeper. And undeposited funds. Undeposited funds is another one of those accounts that I have had clients just not get. They think, well, I've already put the money in the bank, there shouldn't be anything in the undeposited funds, and I've actually had a client delete this account. What this account is, it is specific to an accounting software. It has nothing to do with your bank. This means we have received $110 of money. We have not created a deposit in QuickBooks yet. So it's sitting here in undeposited funds so that we know that on the next deposit, we're going to be taking that to the bank. One of the purposes for undeposited funds is to be able to, one, there is a time lag between receiving money in your office and getting it to the bank. Even if it's just, even if you do the instant mobile checking like I do, I take pictures of the checks and deposit them that way, there's still a lag. And sometimes I will hold checks for a few weeks because I have bills that I know that are coming up and I want to leave that money less than liquid. Or Or maybe I have several invoices that I need to group together in a single deposit. That is what this undeposited funds is for. If you have access to your QuickBooks account, please don't delete this. It will really mess things up. The next thing on here, so most people most of these are, this is cash, this is money you're waiting to be paid on, this is something you've paid for but not used yet, this is money that's tied up in your inventory, and then we get down to your other current assets. And before I get too much further, there is a difference between current assets and long-term assets, and as you can imagine, that is the length of the asset. Current assets are expected to be used up in a year or less. Long-term assets should last for more than a year. So if you buy furniture or equipment, those will show up under long-term assets. You're using them for more than a year. And they will be depreciated, which we're going to get down to here on this lovely truck that they have. So evidently they bought a truck for $13,750, and as we all know, vehicles depreciate. In fact, all assets except for land depreciate over time, and so they've already taken depreciation over the life of the truck for $1,725, which is why you see this number that's different from the purchase price. There is a reason that we do that. One of the reasons is to kind of spread the cost of the truck out over the expected life of the truck. And that gives you a better understanding of what your actual value of your assets are. They will actually depreciate this down to salvage value, and then probably, if they continue to use it, that's great, but they may get rid of it. Now we have our total assets. The accounting equation, again, I realize this is probably about as interesting as watching paint dry, and I'm so sorry for that. But the accounting equation states that assets have to be equal to liabilities and equity. And as we can see on this, that is the case. So let's go through their liabilities really quickly. They have accounts payable, that's money that's going out, bills that they need to pay. They have a credit card. I have actually had a client argue with me and say that a credit card was an asset because they could use it to pay things. And I said, no, it's a liability because you have to pay that back. It is a loan. It is a revolving loan. So they have some credit card balances. They have some payroll liabilities. These are your payroll taxes that don't have to be paid instantly. Your sales tax pay. I'm going to skip payments on account because I don't know what that is. Your sales tax payable. I mentioned in the profit and loss video, I talked about a client that didn't listen to me when I said that you've got to pay your sales tax, you've got to pay it on time, and it is not your money. It shows up here on the balance sheet as a liability. It shows up as a liability so that you can plan for it. When you collect sales tax for your location, that money does not belong to you. It is not yours to spend. It belongs to the state. You are simply collecting it on behalf of the state. So my suggestion is always to have a separate bank account that holds this money so you're not tempted to spend it. And for a lot of my clients, they treat their business as if it was their personal account, so they do tend to want to spend it. But this is a liability. This business has to pay that. Generally, it is sales tax is paid anywhere from monthly to quarterly, occasionally annually, but that is due, and it's a current liability, so it is due within in less than a year. Okay, then we have long-term liabilities. These are due in longer than a year, and as they age and it becomes necessary to pay them sooner, then they would be transferred to current liabilities, which is probably more than you ever wanted to know about liabilities. But we have a loan from Bank of any city, and we have an equipment loan and another bank loan, and so we have $29,000 in liabilities that are going to extend longer than a year. And then we have our total liabilities here. We have opening balance equity, and I get a lot of questions on that, so I'm going to explain this a little bit more. When you Start a bookkeeping system. I like for my clients to stick with the same one for as long as possible, but sometimes it's necessary to change software, or it's necessary to change bookkeepers and they don't want to build on someone else's mistakes. So the opening balance equity is the opening balances of various bank accounts or credit cards that have nothing to do with the period that is being reported. I usually tell my clients, don't even worry about opening balance equity. Understand that it's there. This is when I start a new client. Let's say I started this client on June 1st of 2020. Then any balance that's sitting in their bank account that has nothing to do with anything prior to that, I would put it to opening balance equity, partly because there's no place else to put it and we've got to put it somewhere. Then we have an owner's draw of $5,000. We have retained earnings in a negative amount, and we have net income. So that shows us that they haven't retained much in earnings, but there is income coming in, so maybe they're going to turn this around. I want the actually want retained earnings to be a higher number than that, and I don't want a negative in front of it. Owner's draw can be negative because that's money that the owner has taken out of the company. And by the way, it's completely okay to do that, but don't use the company as your private ATM. That will get you into massive trouble with the IRS. And I counsel my clients not to commingle their funds that way. But they do have a positive net income, which is a good sign. So those are the numbers that I'm going to look for down here. When I'm evaluating a company, I don't look at the opening balance equity so much. I look at retained earnings and I look at net income. And then I'm also going to look at my liabilities, which are fairly low actually. And I'm going to look at the total equity in the company. And that's going to give me a pretty good idea of what I should expect this company to do. I'm seeing that they have some liabilities, obviously, but they're not anything that I would find alarming. So coupling this with the profit and loss that we talked about the last time, I would probably tell them that what they need to do is increase their income. They need to increase their revenues. The revenues are not high enough at 18.7 to be able to bring in enough money to cover their expenses. This does not include, their expenses does not include loan payments or credit card payments, by the way. So that's how you read a balance sheet. It is actually pretty straightforward. The problem, the challenge that I've had with some of my clients is getting them to understand that equity on paper does not necessarily mean that there's money in the business that they can take out. They need to make sure that they have all of this absolutely correct, because if the balance sheet is off, the whole thing's off. If you have any questions or comments or concerns, please feel free to like, share, subscribe, comment below. I want to hear from you. I want to know what it is that I can do, what information you are looking for out of these videos, how to make them more interesting. I'm sorry, I know. This is like watching paint dry. And so that's one of the reasons I always start and end it with my face, because that's got to be more interesting than looking at financial statements. So that's it for today. I will look forward to talking to you again soon. Have a great